Hello everyone. To continue our discussion with the recording process, let's now proceed to steps in the recording process. So the previous video is just to show you the basics of analyzing transactions using debit and credit analysis. Now let us use this knowledge in recording transactions. So again, this is a series of accounting principles video, and for you to follow, I have posted a link of the other videos in the description below so that you can keep track of all my discussion. Okay, so here in these steps in the recording process, first we have to analyze each transaction in terms of its effect on the account. So we have already analyzed that in our previous examples, right? After that, you have to enter the transaction information in a journal. Now, what is this journal? Although I will be discussing it more later on, but just to give you an overview, a journal is a book of original entry because it is where all the transactions that affects the business are initially recorded. Then after that, these information are being transferred to the appropriate accounts in the ledger. So each account has its own ledger account. So for example, cash, we have a ledger for cash. Accounts payable, you have a ledger for accounts payable. That is why we have a T account for every individual account. Okay, so this is the recording process. So first we have to analyze each transaction. So using the knowledge that I have taught you, that increase and decrease analysis, apply the debit and credit procedures. You have to remember that. Then you have to enter the transaction in a journal. So a journal is a book of original entry. Now from the journal, you have to transfer that information to the ledger accounts. So there are a lot of ledger accounts, and the number of ledger accounts depends on how many individual accounts you have in your journals. Okay, so now what is a journal? A journal is what we call a book of original entry because it is where the transactions are initially recorded in chronological order. So it shows actually the debit and the credit effects on specific accounts for each transaction. So if you've analyzed wrongly the transaction, instead of debiting, you entered it in the credit side, meaning your journal entry is already wrong. So that is why you have to have a basic of how to analyze a transaction in terms of the effect, is it increase or decrease, and apply the debit and credit procedure. So this is how a journal looks like in simple illustration. So we have the general journal name, and on the right side, on the upper right side, you have the page number. Then you have the date column, account titles and explanation, reference, debit, and the credit side. So these are the main parts of a journal: the date column, account titles and explanation, the reference, the debit side, and the credit side. And we are going to enter all the transactions that happen here. So what is the usefulness of this journal? So the journal actually discloses in one place the complete effect of a transaction. And it also provides a chronological record of transactions because you have to enter it according to the event it happened. And it helps to prevent or locate errors because the debit and the credit amounts for each entry can readily be compared. Now it will be clearly understood as we go along with some of my examples later on. So the process of entering transactions in a journal is what we call journalizing. So separate journal entries are made for each transaction. What does it mean? So let's say today you purchased equipment worth 5,000 pesos. You have to record that transaction that you purchased equipment. So what are the accounts affected? So using our knowledge, you have cash and equipment if you purchase that for cash. So a complete entry consists of the following. So since we have to indicate that this happens on a specific date, you have to have the date, then the accounts and the amounts to be debited and credited using the knowledge that I have taught you, and a brief explanation of the transaction. So usually you just have to write here to record purchase of equipment for cash, like that. But if you purchase it on credit, to record purchase of equipment on account, something like that. So let's have some example. So using the same example, so that we will all be advancing our knowledge. So the first transaction here, the business invest, or the owner of the business invest. So we have cash and capital, right? So my explanation here should be invested cash in the business. How about in number 2? What are the accounts affected? We have equipment and cash, right? So how do you explain that? Purchased equipment for cash. So how are we going to put that in a journal? Remember that you have to use your knowledge of debit and credit. Here, what are you going to debit here? Since your asset cash increase, you have to debit, and capital has a normal balance of credit. So debit cash here and credit capital. We will look at that in the journal later on. But just to recall, what are the accounts affected here? Here you have to debit your equipment asset increased, and you have to credit your cash because it decreased. Why? Because you paid for that equipment. So look at that in a journal. So on the first transaction, what happened here? So this is how you input it in the journal, although I will explain it later on. So we have to write the date. You have to write the year only once, and then after that row is the month, and on this narrow row is your date when that transaction happened. So here you have to first input the debit, and after that the next row is your credit account, and take note of the indentation. And on another row you have to put the explanation with an indentation again. Now other books have different instruction or journal format, but in this case I base it on an accounting book that I am using as a reference, which is Accounting Principles by Weigand, and this is how to properly input transaction in a journal. So for that cash you have to debit it, and for capital you have to credit. Now you have to leave one space and then input the next transaction. So you have computer equipment debit 7,000, and you have cash decreased, so you have to credit it, and your explanation. So this is for our second transaction. And take note, the purpose of having that space in between is to separate, is to know that these transactions are different. So you have already have seen how a journal looks like, but let me emphasize this standard form and content of a journal. So the date of the transaction is entered in the date column. So you have the year, which you have to input only once, then the month and the day. Then after that, the debit account title is entered in the extreme left margin, as what you have shown in my previous example, and that should be put on the column with the heading account titles and explanation. So the credit account title is then entered on the next line, indented as what you have seen, under the line above. So let's look at once again. So this is our journal. So this is the date, So you have to enter the year once and then the month, and then all of the succeeding transactions you have to write the specific date and leave one space in between transaction. So that is for our first transaction. You have to indent the debit, the credit, and the explanation. Another is that the amount for debits are recorded in the debit column or the left side, and the amount for credits are recorded in the credit column or the right side. And a brief explanation of the transaction is given. And as what you have seen, a space is left between journal entries. And you might be asking, what are we going to do with the reference column? So the reference column is left blank at the time the journal entry is made. Why? Because we're going to make use of that column once our journal entry is already transferred to the appropriate ledger accounts. So let us see again. So this is our journal, right? So you have to take note of the debit and the credit postings or entries. Okay? It should be in line with the debit account title, and the credit amount should be in line with the credit account title. The same with your next transaction, and your explanation should be placed. So take note that it is important to use correct and specific account titles in journalizing. And that always starts in transaction analysis, right? That is why I have told you that you have to be familiar of what are those accounts that are commonly used in that particular business. Or sometimes the accounts are already given in the transaction, but sometimes you have to think of what particular account title you are going to use. So for example, these are the commonly used account titles. You have cash, equipment, building, land, accounts receivable, accounts payable, notes payable, rent payable, wages payable, rent expense, supplies expense, utilities expense, service revenue, rent revenue, drawings account, and capital accounts with that surname of the owner. So there is actually a chart of accounts that the business uses, which starts from the assets. These are the assets account all the way to the liabilities to owner's equity accounts, and they are numbered in chronological order, and I will show you that later on in our succeeding videos. So what we are doing here, actually debiting and crediting, is what we call delete. Okay, so you might notice, especially in our transaction analysis examples, that there is a transaction that does not only affect one debit account and one credit account, but instead it affects, let's say for example, more than two or more than one debit account or more than one credit account. So that leads us to the understanding that there are what we call simple entry and compound entry. So most examples that I have shown you is what we call simple entry, which involves only two accounts, the one debit and the other one is credit. Now, a compound entry actually also happens when three or more accounts are required in one journal entry. And let's say, for example, you purchased an equipment and you did not pay it in full. So you paid cash, but you have a remaining amount to be paid, and that increases your accounts payable. So therefore, you increase your equipment on the debit, but your asset cash decrease. You have credit cash, and you have your another account, which is accounts payable, increased. So you have two credit accounts, cash and accounts payable, and that could happen. So let me show you that. So the first one here is a simple entry, one debit and one credit account. Now in the next transaction, you purchase an equipment and you paid only 8,000, while the remaining is accounts payable. So that is recorded as credit because your accounts payable increased. So these are your explanations. So on the next video, I will show you how to transfer journal data to the ledger in a process called posting.